Where do you sell? When do you sell? If you use your metal in a different way, you don't have to sell it
I'll
in
tell you
that
what's been happening to
situation.
us. Even before we went national, when we bought this little bank up in Minnesota to get the charter, we had been talking to some people that were gold holders, and we actually began to make some loans before we went national. And what was common about this was the borrowers were business people that had occasional working capital needs that had a lot of gold. Specifically, three of them were real estate developers. And from time to time, when they're initiating a project, they need cash.
Yep.
They didn't want to have to sell their gold or silver. In one case, the gold holdings went back to 2004, so that would have necessitated the payment of a very large capital gains tax bill.
Yeah.
But these people were able to access the capital they had tied up in the precious metals to provide working capital for their operating business. It's a perfect, perfect,
Yes.
perfect use of these lines.
That's terrific. I'm sure people listening to this are like, oh boy, this is great. Battlebank.com, correct?
Correct. Correct.
Well, my friend, let's turn to those metals. We came out of we ended up the bat last quarter of 2025 was tremendous, and the first couple of months of 2026 off to a hot start as well. And then we got a curveball thrown at us about 2 weeks ago, and it has been interesting to watch the markets react, Rick. And I'm in the thought, I don't want to call it a market inefficiency because that's not the right word, but I feel like they're getting it incorrect in the short term, where crude is going up and the dollar's being bought in a safe haven. And then it's like this, the machines are just programmed to sell everything when that happens. Is that the right trade, Rick? Is that the long-term trade, the longer this goes on, or is it, like I said, an inefficiency?
Is it an inefficiency?
A mental
In the
inefficiency.
near term, they're uncorrelated.
Yeah.
I think what
Okay.
happened in precious metals was simply that the market gave us too much too quick.
Yeah.
Uh, when people say to me, well, God, the silver price is down to 80, I say, really? I thought it was up from 20, you know?
Right.
So you have to take time frame into account. Anytime you see a hyperbolic chart, what the Canadians call a hockey stick graph, you need to know that it corrects itself 99 times out of 100. And the backside of a hockey stick is just as steep as the front side was, but it's a
Yeah.
lot less fun if you're long. It doesn't usually retrench as far as it went up because it usually went up, goes up, but it retrenches. You, at the beginning of this call, Craig, mentioned the decade of the 1970s. Unlike some of the listeners on this call, I was there, cognizant.
Yeah.
And I recall that greatest of all gold bull markets, where the gold price went from 35 bucks to 850. Four times during that decade, the gold price fell by 25% or more. One time in 1975, and I remember it like it was yesterday because I was long, the gold price fell by half. So you need to understand that cyclical or volatile declines can occur within a secular bull market, and it doesn't change a damn thing.
Mm-hmm.
If you have the psychological and financial preparedness to stay the trade, this isn't even noise to you. It's a distraction. If you don't have both the psychological and the financial strength to stay the trade, this could be fatal to you.
Yeah.
Now, I'm fairly public about the fact that in the real runoff, I sold about 80% of my silver. I'm not suggesting that other people do it. And I think the reason that I did it is instructional because it's personal. I bought silver when it was hated. I bought it when it was hated because I thought when it just ceased to be hated, even before it became popular, that there was a lot of rebound in price. I bought it too, and we've talked about this before, Craig, you may not remember, but we talked about the fact on your show that when the momentum in the precious metals trade was established by gold, as the generalist investors tiptoed into the precious metals space, that market leadership would change from gold to silver.
Mm-hmm.
When that happened, that was the key to me that silver was unhated. I own gold in my investment portfolio. I consider gold to be a savings asset. I own silver in a speculative portfolio, a very different part of my portfolio. And in my speculative portfolio, when an investment performs as expected, I don't care how high I think it can go. I just care whether on a risk-adjusted basis, it's the best speculative avenue for my money. I bought the silver because I thought the price could go to 50. I was wrong. It went to 75. Well, it went higher, but I sold it at 75. And I did it because in a sober moment, I recognized that if the silver price didn't have to go up anymore, it could, but it didn't have to. The tension on the spring had been released in the move 20 to 75. And if, as a thought experiment, silver traded sideways for a year, by definition, I'd make no more money on my silver because it traded sideways. But the silver stocks were being valued by Bay Street on a $45 price assumption. So without the silver price going up, the silver stocks could escalate on a valuation basis by up to 50%. If the silver price went up reasonably, the silver stocks would go up too. Paradoxically, if the silver price were to decline from $75 an ounce to $50 an ounce, given that the valuations were predicated on a $45 assumption, I had more shelter to the downside in the stocks than I did in the silver itself.
Yeah, that's true.
So for me, it was a good decision. I should also say I scraped some money off the table, all the way to the table. I got out of the way of speculation, which is to say I bought physical gold with it, which is the way I save.
Right,
So I bought silver stocks, physical gold, and oil and gas stocks with the proceeds. I got lucky in the last part of the trade.
What would you be looking for to get back into physical silver then, Rick?
A big price decline.
Or just time going by and gold going up, or a big
speculation for me. I segregate among the precious metals by investment and speculation. I save in gold. I speculate in silver. So silver would have to be the best speculation available to me.
Yeah.
And mercifully, I cover the whole gamut of natural resources. To me, successful speculation involves the asset class that I'm speculating on being hated. And sadly for me, there's not very many sectors and resources that are hated now.
Yeah.
When you and I first started talking 4 or 5 years ago, hate was abundant.
Right.
The opportunity was abundant. But my life has changed. There are times in your life when you're writing checks, and other times in your life when you're cashing checks. And I happen to be in a check cashing era right now.
Right. Let me go back one more question on this point. It seems as if in the short term here, this first 2 weeks, that the market looks at this trade and says, okay, gold price or oil price is going higher. It's going to be inflationary. So sell bonds, higher interest rates. The Fed's now going to tighten because of that. Where I sense that it's not accurate is that actually the Fed will probably going to be more concerned about economic growth and move to cut regardless of what the inflationary impact. How do you feel about that? Do you think that has legs?
I think you're right. I think the oil price moved up because people were unnerved about the supply side in oil, and I think they should. Yeah. You and I have talked before the wars, plural, that we were underinvesting in sustaining capital in the oil business to the tune of about $1 billion a day. Now, I had anticipated the supply shortages would take place in 2029. Fast forward to a war.
Yeah.
And that changed, obviously, everything. It didn't change the underlying economics around the oil business. Oil supplies will get tighter, and the market will respond by price. Will these prices hold? That's a function of peace. When or if we have peace.
Yeah.
The second question revolves around the U.S. dollar, and there the answer is trickier, and it will be very unpopular with a Canadian audience. My friend Doug Casey described the U.S. dollar as the worst currency in the world, with the sole exception of all of the others. The U.S. dollar, for all its fault, is the most liquid currency in the world,
right?
And it's also the most transparent, the least opaque currency in the world. It is a currency where most of the international debt in the world is denominated, which means the demand for dollars to pay back debt irrespective of Mr. Trump's popularity or lack thereof, is very high. No other currency has that.
Yeah.
The last time I looked, about 2.5% of the world's international obligations were denominated in renminbi. So what do you think the relative demand for debt service between renminbi and US dollars are? This one's fairly simple. As absolutely ugly as the numbers around the US dollar are, as ugly as they are, paradoxically, they're uglier in other places.
Yeah.
And when people get very concerned about their liquidity, about the sanctity of their liquidity, the global demand for US dollars in the past 4 weeks has gone absolutely crazy, including by countries that already have too many of them. Now, I think this is a fairly short-term phenomenon. Let me rephrase that. I think the US dollar over 10 years will do relatively well against other currencies. I think the US dollar over 10 years absolutely, that is not compared to the Canadian dollar or the euro, will do extremely well. Extremely poorly. I think that the purchasing power of the US dollar in isolation will fall by 75% in purchasing power, which means that a basket of goods and services that cost you $1,000 today will cost you $4,000 10 years from now.
Yeah.
I lived through that in the decade of the 70s. The purchasing power of the US dollar in that decade fell by 75%. Not coincidentally, Craig, the gold price ran 26-fold.
Not coincidentally. That's
That
right.
isn't to suggest it's going to run 26-fold from here, but I would ask your listeners to consider the probability, I think, that gold maintains its purchasing power.
Yeah.
Which means that the nominal gold price in US dollars, should mirror the decline in the purchasing power of the US dollar, arithmetically.
Right.
Maybe it isn't 4-to-1. Maybe it's 3. Maybe the gold price only doubles in 10 years. You get the point.
Right.
You own gold defensively. If you have the courage, you invest in gold stocks, taking the company risk around the price trend in gold. If you really have guts, you speculate on the gold side. You do it predicated on the probability of stronger nominal gold and silver prices.
Mm-hmm.